Hi, I'm Jessica Rabe, one of the co-founders of Data Trek Research. Readers of our daily work know we're huge fans of disruptive tech companies because they're a critical driver of long-term equity returns. But do you know how much tech you actually own across all your equity investments? This is crucial information for every investor. Everyone knows U.S. indices like the S&P 500 are concentrated in tech, but exposures vary widely by region and investment styles. So today we're going to show you how much tech is in a slew of popular investment funds in those two categories. The reason this is such an important topic to discuss, especially in the case of U.S. big tech companies, is that they're very highly valued. Here's the 12-month forward PE multiples for the tech sector and 8 big tech names versus the S&P 500. Yes, we also categorize Broadcom as big tech. As you can see, the S&P tech sector's forward 12-month PE ratio is almost 6 points more than the entire S&P 500 and represents almost a third of the index. The 8 big tech names on our list have an even higher weighting in the S&P than the tech sector itself, at 35%. And even when excluding Tesla, its forward 12-month PE ratio is over 10 points higher than the whole S&P and a few points more than the tech sector. We personally don't have a problem with these high multiples, given that these companies are global market leaders with large competitive moats and plenty of cash to keep investing in innovative technologies. However, we know many investors are concerned about their high multiples, and it's important to keep in mind because they have an outsized impact on the S&P given that they make up over a third of the index. Now, let's move on to tech weightings by geographies and investment styles. This includes the tech sector plus any major tech company not categorized as tech. For example, Amazon at 21.5% and Tesla at 17.9% make up nearly 40% of the consumer discretionary sector, and Meta at 19.7% and Alphabet at 19.9% also account for almost 40% of communication services. To start, here's the contrast in tech weightings for the All-Country World ETF, ACWI, versus the All-Country World ETF, ACWX. ACWI has double the tech exposure of ACWX. It just goes to show the lack of major public tech companies outside the US. This next table shows the difference in tech weightings around the world in more detail. The tech sector plus Amazon, Tesla, Meta, and Alphabet now make up almost half the S&P, nearly 6 times more tech exposure than MSCI Europe, which really only has ASML and SAP to show for on this front. We don't see this dynamic changing anytime soon until the government policy and the continent's culture shifts to a more business-friendly attitude with an emphasis on disruptive technology instead of old-line businesses. And the same goes for MSCI Japan, with only 2 tech companies, Keyence and Tokyo Electron, in its top 10 holdings. Emerging markets are a different story, though, with tech making up around a third of the index, depending on if you include China. We do advise caution here with China, making up over a fifth or 27% of EM, given that its stocks, especially tech, have been quite volatile over the last few years amid the government's crackdown of private enterprise. Finally, U.S. large-cap equities may be heavily concentrated in tech, but the sector is a clear underweight in the Russell. The S&P has over 3 times the tech exposure of the Russell. So a fundamental disadvantage for the Russell is that exceptionally strong companies eventually graduate out and move into larger market cap indices, with the Russell missing out on that future growth in disruptive companies. Moving on now to tech weightings by investment styles. If you thought the S&P 500 was highly concentrated in tech, check out U.S. large cap growth. As much as we're bullish on tech, large cap growth has too high of a weighting in it for our liking at well over half of the fund. Investors in large cap growth need to therefore have an aggressively bullish outlook for tech and be comfortable with the volatility that comes with it. Otherwise, the S&P offers plenty of tech exposure. U.S. large cap value has a higher weighting to tech at over a quarter of the fund than one might have suspected, and it's dramatically higher than its small cap value counterpart at less than 7%. In fact, S&P 500 value has more tech exposure than Russell 2000 growth, or even the MSCI US Momentum ETF, MTUM. Obviously, the two dividend funds we listed both have low tech exposure, but there's still a 3-point difference there. Even if it's the same investment style, sector, or individual weightings can be noticeably different. Lastly, here's a difference in big tech weightings for the S&P 500 and NASDAQ 100, S&P 500 and NASDAQ 100, also known as the Qs. As much as these 8 big tech companies represent over a third of the S&P, they're half of the Qs. I personally am a fan of both, and I'm invested in both. But I also have a long investment time horizon. So again, here's another example of sticking with the S&P for the more risk averse or worried about these stocks' high multiples. So I have 2 takeaways from all this data. The first is that, as I said at the top of this video, we're big believers in disruptive innovation driving long-term equity returns, and have therefore been bullish on U.S. large-cap tech since we started DataTrek over 7 years ago, which has worked out very well. As much as many of these names have high valuations, they also help drive earnings growth at the index level and have very high returns on equity. Additionally, we continue to favor U.S. large-cap equities given the lack of disruptive tech companies in Europe. We also view MSCI EM in China as trades given the former's outsized exposure to the latter and the latter's regulatory, economic, and geopolitical hurdles. Ultimately, they've not been long-term value creators, with MSCI China trading under where it was in April 2011 when it launched, and MSCI EM trading at 2007 levels. The second is that the S&P 500 has a higher weighting to tech than most U.S. equity market cap and investment styles. We believe that is a feature, not a bug, over the long term. For investors uncomfortable with this outsized exposure, there are many other options that are less concentrated. However, it's important to review a product's weightings given the sometimes dramatic difference even within the same notional investment style. With that, thank you very much for taking the time to watch this video. Please hit the like and subscribe button if you enjoyed it. And you can read our daily investment analysis by signing up on datatrekresearch.com. Thanks again for watching, and we hope you have a great day.